Hi, welcome to another video. This is the Lifestyle Trader Michael. I'm just going to cover what's happened over the weekend as to the markets and to see how we can, if it's possible, to avoid these crashes. If not, then how do we manage these risks? Because these shocks can occur. So let's take a look at the markets. So I'm referring to the general stock market itself, predominantly the US. Let's go have a look at the US market and take a look at what's happened, the carnage that's happened with the corona, whether it's an impact, anything that can shock the market immediately. Now, if we go back in time, we have known about the coronavirus for some time. The markets have factored that in somewhat, so to a degree, but nothing had happened to the market then. So if we go back to this day here, you'll see that up until that point where the big crash had occurred, the flash type of decline, you'll find that the market hadn't really done anything to show signs of that, and hence why these shocks can catch traders off guard, and particularly if you're using margin. So winding forward to today, the next day you'll find that we see a fall and then a major fall and then the continuation as to this decline. Now these sharp 3 days will see most traders panic already at the gap. The big gap that occurred here is a sign of a lot of selling pressure, hence you find the gap in the pricing between the previous day's close and the new event that occurred. These continuation of these red bars can be quite dangerous if you're trying to buy dips. So up until this point, if you take a look at the markets from a trend line point of view, we draw it from that low to that significant low of end of December 21st to that pivot low there. We did break through it. I don't pay quite a great deal of attention to these trend lines as such. I use them as a way of referencing where price has been. Same with Fibonacci's. They give you a good indication, but they're not trading strategies. That's the most important. There are a lot of those who use these indicators. If you can factor a strategy around it, great. If it's used as very discretionary, it can be hard to replicate that. That's the reason why I'm very systematic in my approach. But when discussing the market, there are good reference points to refer to where markets have been. And if other traders are looking at them, and investors, it does give us an indication of potentially buying coming in. But that being said, you need to factor a strategy around that to better implement it correctly. So if you do have it, great. Allows you to be able to take advantage of these things. But just take a look at from the trend line in reference to what I've drawn. You'll see that we broke on the let's say on this red candle. With 5 days, we closed at that point, and the following day we simply gapped right through it. And then we've got the final Friday. On the Friday's close, the 28th, we have now the first green candle. Does that mean that the market is going to rebound? We really don't know, but it's a good sign. So if we add volume, which you'll see here, there was a lot of volume coming in, massive amount of volume. If you look back in terms of history, volume-wise, the last time we even reached this sort of volume was, there's spikes here, but you need a build-up. You can see there's been a build-up of selling, and eventually that last candle meant that algorithmic, predominantly because the stock market's driven by a high percentage, I don't know on the top of my head, but it's certainly in significant figures of, from last look, probably I'm taking a good guess at around about 60 or higher of it's driven by algorithmic or machine algorithmic buying and selling. In this case, buying here. In the court of the news, when this occurred, it would have been selling, because the fear came in, the gap occurred. It noticed that the market's going to crash, so it kept on selling, and then it realized that it's gone down further enough, and then it wiped out the sellers and reversed that massive candle here, which is significantly, compared to the other reversals, very, very large. And the volume signifies that there. Now, I'll just get rid of the volume for a second. And I'm just going to show you in terms of retracement. So to answer the question, can we know in advance and be able to protect ourselves from these shocks? Really, we don't, because as mentioned earlier, the virus has been in effect in the market for some time, and talk has been about it, probably due to severity, but it really could be hiding an underlying problem in the marketplace that leveraging. You can imagine if you borrowed money and if you're using a highly geared strategy and you're holding overnight, what tends to happen is a cascading effect. Now, as this day here occurs, where you've got selling occur on that day, and then it gaps next, you'll notice that what we've stop orders, if you ever trade and you've been stopped out, you'll find that with margin, if the market does open lower, it means that you'll be forced out of your long position. That causes selling. As it sells further the second day, it causes more selling and more selling. So what happens is that you'll get a cascade effect. As prices decline, more selling builds up until you eventually get an effect where the sellers of the stop losses predominantly have been wiped out, and those can hold will hold, and those that are ready to buy will buy back in, and that equilibrium is upset, and then you get the market potentially reversing. We don't know as yet, but there's good signs that this could be the case of a reversal. Now on that side of it, I've drawn a Fibonacci from that low to high. If you're those not familiar, Fibonacci gives us key support levels based on, you could call them sacred numbers or numbers that are ratio in nature, in this case in human psychology and in the market. So we bounced off the 50% level. 50% is quite significant. It means that we've formed a decent correction. Normally if markets are weak, we should go down to the 0.618 or the 62% area. That will take us down to 7,040, let's say 7,050. It's too early to say. This could also be a false reversal point and lead more buyers to come in, only to be hammered down to the next level. So I would certainly not be surprised if we go down another day. And remember that a lot of traders and investors over the weekend don't want to be caught up the following day. So they may have close out their position, or some would have bought in hoping that Monday it'll resume a potential reversal. There's a highly likely chance that it could, given that bar there, but we really need one more candle at least to confirm a reversal. What I mean by reversal is we need it to break this high at this point here. So let's get rid of the Fibonacci. And what I mean by that is if we don't break this level in the market, this high here, which gives us a value of 29.59. So let's call it, we've got to really break 29.60. If we break the 29.60 high and then cover this gap here, it takes us close to 3,000, the psychological level. It will give us a good indication that we may reverse at this level. Whether the reversal goes back up to anywhere near all-time highs will remain to seen. It's more likely going to take quite some time. There's many types of recoveries. A usually common recovery could be a V recovery in a strong market. So you have markets declining very rapidly and you get a V type of recovery, which means you get a bounce down and you get a bounce back up, such as the V's form. More often than not, it will bounce potentially half of its corrected amount, like here, and it could potentially go back down. And if we're in a potential bear market, or start of a bear market, we could have a known as a ABC correction. So let's just use the ABC tool. So that means that there's a good chance that if we have this correction really unfold as a potential setup for a proper market correction, then there's a likelihood that this is only the start of it. We don't know. Taking guesses of what's happening in the future is really not my forte. I don't like to generally do that. But as a way of explaining how to navigate these corrections, one really must have a plan, and I'll go in a second and cover that. But reality is that if this correction comes down, we have a proper correction that could take us down to, who knows, below, at least we have we've already broken past this previous support here at these highs. So it's anywhere the market can go from here. Really the next major support is here at 23.40. That's still far away to go, so I won't even mention that. But the next level significant one here was the previous high. You've had previous lows there. So that there, if we bounce, we've got to really try to hold this low area, which coincides with this high here back in January 2018. Enough of that. Let's have a look at the other markets, and I'll share with you how to manage the risk. The answer really is you can't really predict this. This is sudden. So it could be a major event that happens overnight. Now, if you have the forte of exiting your position, at the time, making the decision can be very tough without having experience and the ability to do that. More often than not, the trade investors will hold on, hoping that this is only a short correction, and end up losing their open position through margin call if they're using margin, or getting totally afraid under the panic, making irrational decisions and exiting prematurely, or not having a plan and just sitting it out and hoping for the best. That's really not the best way to go about it. But let's have a look at the other market, obviously being China, the most impacted one from the coronavirus. They haven't actually done the same as the rest of the market. They have rallied back up since their drop over here, and then they've actually rallied back up, filling up that gap. They've only pulled back now. Could this mean that they could start the next descension down? We really don't know yet. But if this descension goes down, if it equals this length here, which is usually a typical correction, where the length for this would be the equal of the next leg down, and if it's a much more corrective move, it will extend more than this leg here. So that remains to be seen. But as you can see across the board, gold is also doing terrible after its rally. It's corrected all the gains it's made over a course of, let's call that a bit over a week. So one major move down has corrected pretty much over a week's worth of price action and taken it down to the significant level of 15, let's call it 1560, 1565. So will gold rebound? It really depends on. So what has really happened, I believe, is the algorithmic trading has caught on board that the panic has ensued, and you find that they sell irrationally to correct the market down. Now, same with crude. Crude's going to be affected, obviously, with activity slowing down. If the economy slows down, then crude demand is going to drop. We are going to reach significant lows of $42.30 a barrel shortly after. If we break that, then we are going to be seeing major lows occur. This is the next significant low, which is around the $26 a barrel. Now you can find that a lot of producers, particularly in America, the fractal type of oil extraction is going to suffer quite significant there, and they are going to have a lot of problems with fracking oil with these prices. Unlike with the cheaper oil coming out from the Middle East, this is definitely going to affect that particular market. Now I'll cover quick. Lastly, is the silver market, and we'll see how much of an impact it's done on that. As you can see, silver is much more lagging, down 7.2%, much a bigger correction than gold. You would expect that. It's a much more volatile metal compared to the gold's market, and that is a natural occurrence. So you can see that the correction has really taken it down to, if we take correction levels down here, we're almost at the 0.618 level. I believe we should get there. Normally with major sell-offs like this levels gets breached often, and more often not penetrates below that. So that's that on that side. Now let's have a look at a way of how to manage risk, because really, as we've explained earlier, unless you have the fortitude and the experience, really the mindset to be able to automatically remove yourself from these shock events, more often than not investors don't know what to do. But let's say you implemented a plan in place that protects that. If you're already in a position, the only real way to exit your position is to have a form of trailing stop. Now, what is a trailing stop? If you're not familiar with that, if you're just simply investing, buying, holding, simply that purple line there is one of a trailing stop that we implement on our ETF strategy. So I'll go in a little bit detail about ETFs, but we're buying indexes that are, in this case here, we're using the NASDAQ ETF. It's the ProShare. So we're buying the overall NASDAQ index, the technology stocks. So that purple line there is a trailing stop. So anytime the price breaches that, touches or breaches that level, we exit at that price at the time. Now in this case, it would have been exiting at 126.50. Now we already had a trade in this one here. Not this one, we have one in the S&P. We've closed down. I'll go and show you the actual algorithm that we used, the strategy itself. But that trailing stop there, if we were in it, would have got us out at 126.50. However, we were in this trade here, on the Pro Shares. Now I'll show you the actual trade. It was it would have been on this day here. We would enter. Let me highlight it there. So that means we bought because at the time, this is a weekly chart. So we're looking for good momentum in the market, and weekly charts are a great way to identify weekly momentums and allow you to stick with them. The obvious part of it is being able to manage that risk. If you manage momentum, momentum's not going to always stay up. So part of that, our strategy is to look at actually exiting. Now, in some cases, the shock events occur. You can't predict them. Now, we bought on this day at around where are we? 159.95. So that would have been we've entered around that level at the open of the first day or so. This is a weekly bar. We held it for, in total, including the first week we bought, two weeks. And obviously the Monday, it opened up and gapped down. At the open, our trailing stop didn't really get stopped out. As part of what you won't see here is we have initial stop, which our calculator automatically tells us is already built in. So one of two things can occur. If our initial stop, which is usually a little bit further, it will allow us the market to breathe. More often than not, the trailing stop will be our exit point. That meant that on the day of the open on Monday, it traded lower. We took our losses. Our wounds were light. And we can also come back and buy it at any point when the market actually reverses, which potentially can occur. So what I mean by this, by having the trailing stop, you're going to limit the loss. If you're trading margin, in this case, we're using a leverage ETF. We don't have the problem with the margin call because it doesn't have a margin. It's got margin built in. So it really can't go to zero, which means the whole market has to go to zero. That's the added benefit of an ETF rather trading than using, let's say, a product like CFDs. By doing so, if you don't manage your miss, you're going to have problems with the margin and the leverage yourself. So that being said, we exited there. Now, as I mentioned, there's no way to really predict these key events. The only best way is to have risk management in terms of exits and actual allocation of money correctly to these positions in order to minimize the loss. Now, if you had very large position on margin, even though you have a trailing stop, the wounds or the damages can be significant. So that being said, it's another topic for another day, but essentially having a trailing stop is very powerful, coupled with an initial stop. Now the difference of the two is the trailing stop moves with the market, where the initial stop stays intact. So if a major event occurred the same day, in this case the same week, we're out of it. We don't have to wait for the following week to exit our position. So let's show you the actual entries and exits for that. That's the NASDAQ one, QLD. So we bought here, we exited. Now I will go through this in another video, but in terms of that green line, that's our profit taking level. The minute it closed above, it's telling us we're at extreme levels. So as you can see at all-time highs, that's extreme. So what this is measuring is past price levels and telling us where these extreme levels can occur. So the minute we close above it, it indicates that we are at extreme. Take profits, be cautious. So we've did it here, and we've did it here 3 times. Now, the good thing about having an a strategy, is even though we take profits, we can always re-enter, which what we did. So we really didn't miss much of this trend. We had a bit of a break between the two periods of where we exit and entry. But what's most important is that we didn't get back in. Now, that's the other side of the tale, is that at the time we exit that position, because it was extreme, we actually were not in the market at all. So the next day it opened, we are not buying. We're not in the position, or we're not caught in that. We do have a new opportunity at 147.38 for next week. So that means that it's still got long to go. This will automatically adjust to price levels, but it's saying with current volatilities where it is, the next buying opportunity is almost back at all-time highs, which is unlikely to occur next week. So that being said, let's go look at the SSO, which is the S&P 500 leverage ETF. Now, as I mentioned early on, we were in this trade. My apologies, we were actually on this day, the week before. So we got in the week before, but we didn't know, obviously, where that's going to occur. And our trailing stop there, which is that red dot there, show us a stop level of 149.22. On the open, it penetrated our level. We exit that market. We're not sitting through this deep loss here. As mentioned, we can come back to buy it, and it's still at 165.06. As prices correct themselves or readjust to these higher or lower levels, it will automatically correct itself back down, and we could be buying again at these lower levels. So we've exited our loss, taken our loss, and we've removed ourselves from harm's way. So that's really the you could say the moral of the day, or the actual learning experience from knowing about shocks, is that to have a plan in place to know where to take your position out of the market. In some cases, take profit and get out of the market. You can see that the market, in terms of the indicator, showing that we had reached our level here. Because it's adjusting with market, it didn't pick up here. Not all the time will be correct, but we did pick up here. We're reaching high levels. We took our profits. The market pulled back a little bit, where the Nasdaq kept on going, so it stayed higher in that region. Hence, it was picked up with our profit target, profit taking indicator. However, because it pulled back, it pulled back from these extreme levels. It was not able to pick it up at this area. That being said, the trailing stop did pick up and saying, get out, take the loss, resume. Well, that's all for this video. Let me know what your thoughts, whether you're using a trailing stop, and how you manage shock in the market. Thanks for joining for this video, and I'll see you in the next one.